Everybody, welcome back to the Teaching Tax Flow Podcast, episode 193. We would normally say get your head out of the gutter. However, get your head out of the kitchen. And you'll know exactly what I'm talking about here momentarily. We are going to talk about a topic from another case study of that Defeating Taxes book. But this specific case study, I know we're going to cover some great topics in here, some great strategies, etc. for this specific case study. But I know my co-host, Chris Picciurro, is more excited because of the last name of these people from this case study in the book. So I won't introduce it. I'll let Chris do it. Chris, let's get this one off and rolling. Volley me something. I'm thinking of a joke here, but hit me with it, man. What do we got?
Well, not a bad term. So today we're talking about the fourth out of the four real life case studies that we write on right here in our Defeating Taxes book, chapter 19, which is Joe and Jill Pickleball. Obviously, the last names are the first names and last names have been changed, but the fact pattern is very, very common. And we've walked through this journey of different case studies. And I think with the four case studies that we write on in the book, we've captured, we captured a vast majority of U.S. taxpayers from different marital statuses to ages, income levels, asset levels. And I think with Joe and Jill, the reason I wanted to put this in the book is that a lot of times people in their situation feel like it might be too late to do tax planning, or that a lot of times people that are early retiree, I don't like the term early retiree, but I guess that's younger retirees, we'll say.
Younger, proactive,
retirees,
ambitious, maybe?
And
ambitious
people are living
retirees?
longer. Yeah, or maybe a better term would be pre-Social Security drawing retirees, before they hit full Social Security age. So a lot of times these folks were in their peak earning years in their mid-50s to early 60s, and a lot of times they may have not done a lot of tax planning. They haven't put a lot of money away in tax-free instruments. A lot of times it's tax-deferred or it's in their home, and they've got a couple issues, right? First of all, they know that they're going to have to take money out of their retirement plan in the near future, and that's going to be taxed or whatever their rate is. And they're moving from what we call a red diagnosis, typically, which is that higher than 25% marginal tax rate, into a green diagnosis, because now they might have a small pension, they might have Social Security, they might have some income streams, but ultimately their taxable income is not as high as it was a year, 2 years previously. So and a lot of times these folks are enjoying things like, maybe their grandkids, maybe fishing, golf, pickleball, and they have more time on their hands and they're thinking, gosh, what could I be doing right now? Because they see this big freight train coming, and that big freight train is, we've worked our entire life to save for retirement. We're quote unquote in retirement. And now we know that we're going to be forced to take money out of our pre-tax accounts, our IRAs, et cetera, when we hit what's called required minimum distribution age in their 70s. And even though we don't necessarily need that money right now, we're going to have to pay a tax on that. So this is where things get a little interesting. And we like to want to dive in. Yeah, let's dive in. And this is chapter 19, the Defeating Taxes book. So for those of you that have already read it, listen to this book. Thank you. We genuinely appreciate your support.
Yeah. And you started this off too by saying, about tax planning, right? Some people think it's too late, too early, all these things around it, right? And the answer to both of those is kind of an overarching, it's never too early, it's never too late. Right. So you might as well start doing it, because really, I guess from the taxpayer's perspective, they might think of it as like, a proverbial tax day, right? We're doing the air quotes here for people that are watching it. They think of it as a yearly thing, like, oh, everything I do this year is just for this year. It doesn't really go beyond that, which is not the case. And that's where we come in. And especially this case study, I know this one, obviously knowing how it ends, it's a great one because it runs through a lot of stuff and it is very relatable.
Yeah, try to legally not to reduce tax they pay in their lifetime. So let's set the stage for Joe and Jill. They're married. They file jointly. They are not working, and they're in their mid to late 60s, and they're in a high income tax state. So maybe they might be in, I don't know, let's throw them in New Jersey. We pick on California enough, right? The combined marginal tax rate's about 22%. So it's not exorbitant, right? Remember, red diagnosis means 25% or higher. They have a lot of liquidity. What does that mean? They have a lot of money in their brokerage accounts or in checking and savings accounts that they have access to, that if they pull that money out of a checking or savings account, that they're not, it's not going to be necessarily taxable. So they've got a lot of brokerage accounts, and they're kind of looking for that. They're not in a situation where they're counting on their tax refund to live on. Their income is coming from multiple sources. It used to be just W-2 wages, but now they have a Social Security. They have pension payments. They have some portfolio withdrawals, interest and dividends. And now they're also grandparents, right? So they're pretty excited about that. But they're also concerned about, they're concerned about maybe helping out with that education expense for their grandkids. So by no means are they quote unquote struggling financially. By no means do they have a immediate tax problem. However, they realize that we've got some assets in these retirement accounts, and how do we become tax efficient with what we have? And also, you know, do they need to, are they in a living situation where do they want to downsize their house? Do they want to change change their state of residency to a non-tax state? And it's interesting with Medicare too. So, we talk a lot in our content on teaching tax flow about hidden taxes, right? And what you have to understand is that when you are on Medicare, if your income goes over a certain threshold, you are required to pay a higher premium for that Medicare. That does not show up on your tax return at all as a quote unquote tax, but there is a tax to having a large amount of adjusted gross income, because that could affect your Medicare premium. It's a 2-year look back. And the other thing is, if your other income is of note, your Social Security benefits could be taxable. Up to 85% of those benefits can be taxable. So those are hidden taxes, and that's what these folks are thinking about. They might not be thinking about estate planning too much. With the One Big Beautiful Bill Act, we have about a $15 million estate tax exemption. So between them, they could have $30 million of assets and pass those on to their beneficiaries with no estate tax. However, they want to be tax efficient, just like everybody.
And I'm glad you also mentioned something else here, whether you know it or not. And to give a little preview to people, 3 or 4 episodes for now, we're going to dive into some specifics, what people can do if they only get a W-2. So somebody who's not self-employed or anything else, they think it's a simple situation. You mentioned these individuals started off or may have started off with that, but now there's other sources of income coming in, which does, in a sense, some people might look at it as, hey, it complicates my situation. But really, from the tax side, it could be a huge benefit because now you're even in more control of really your tax life, for lack of better
Mm-hmm.
terms, right? But if you ignore it, then you're not in control, right? So
And yeah, so like, let's say, what are their concerns? Let's think. The first thing is, we've walked through that 4-step process: diagnose, prescribe, IQ test, implement. Their concerns are reducing their tax over their lifetime. Their concerns are having enough money to make sure they have the medical care they need, making sure they can maintain the lifestyle they're comfortable with, thinking about now they have grandkids, thinking about the education of those grandkids, making sure that their family has financial security, and also thinking about their assets that have appreciated. So those assets that have appreciated mean, what does appreciated mean? That means they've gone up in value. So they might have significant amount of stocks and mutual funds that have appreciated, and we know that there's a difference between realized and unrealized capital gains. So just because they own securities that went up in value, until they sell those securities, it's not a realized capital gain. But whoever sells it is going to pay a capital gain tax on that. What about their home, their primary homestead? Is that becoming a burden to them? Are they, do they want to downsize? Can they take advantage of the Section 121 exclusion, meaning the primary homestead exclusion? Can they, and also they want to think about, do we want some assets that we own to pass on to our beneficiaries with a step up in basis? So there's so many things to consider. And those are the concerns I would say for these folks. If they're in a 25% they're barely a red diagnosis. Again, they don't have a tax problem, but they have a tax situation. So what can we do for them, right? What are some of the ideas we would have for them? Well, one idea is just kind of thinking about those pending retirement distributions, what are called the required minimum distributions. What we would probably want to do is say, okay, let's assume that they have, let's look at their marginal tax rate and let's fill up their relatively lower marginal tax rates with by either accelerating green diagnosis, right? If accelerating income into certain years, such as Roth conversions, maybe some capital gain harvesting, that's an option. So instead of waiting until they have to take money out of their retirement accounts via required minimum distributions, we take those distributions now, or if they don't need that money, we could do a Roth conversion and let that money grow tax-free. That's a really good option. So retirement distribution planning is going to be important for them. Once they get to the point where they are in a situation where they have RMDs, which are required minimum distributions, sounds like they have a significant amount of assets, and they're going to say, well, we don't really need all this money. So just to put it in context, John, let's assume someone has $2 million on their retirement accounts and they hit the required minimum distribution age. Now, this is all based on if you're a male, a female, who your beneficiaries are, what your life expectancy tables are. But in general, you're going to have to take out about $120,000 out of that retirement account right away if you want it or not, which is all taxable, which all hits your Medicare surcharge. So they might say, we don't really need all that money. So one of the things we might want to do once they hit the required minimum distribution age is do something called a QCD. That's a qualified charitable distribution. And what that does is that takes money out of their retirement account and puts it, rolls it right into a charity. That way it's never taxable. And they meet the required minimum distribution requirements.
This podcast is brought to you by Legacy Lock. If you are new to estate planning or simply need to review your current plan, Legacy Lock makes it as easy as pie. Legacy Lock is a unique platform that enables you to easily complete your attorney-drafted documents conveniently from the comfort of your home or office. Your first step to this peace of mind is simply visiting teachingtaxflow.com/legacy.
What if they have appreciated stock that they want and they want to be charitable? They might want to donate that stock in kind to a charity and take a tax deduction. So, John, let's say something they bought, I don't know,
which is Amazon stock. I think everybody can associate with that one.
Yeah, $100 or let's say $1,000, and now it's worth $100,000, and they're thinking, well, we really don't. If we sell that stock and donate the $100,000, then they'd pay tax on $99,000. But if they donate the stock, an appreciated asset, to a charity, then they get a $100,000 tax deduction. So those are some of the things you want to think about, because these people might be very charitably inclined. So that person might come to you as a tax professional and say, hey, we really want to do, our high school or our church, they've done so much for us, and we want to make a very generous $100,000 donation. Our job as tax planners is to say, great, awesome that you're generous, but how do I do that tax efficiently? Because the common person would just say, I'll just take $100,000 out of my retirement account and donate it to charity, which would be a tax disaster. They would probably lose like $20,000, $24,000 of tax by that move versus just donating the stock in kind. So those are some of the things we're thinking about for the pickleball couple. Now let's talk about their legacy, right? Let's make sure that their beneficiaries are up to date. Let's make sure that their estate plan is up to date. And then thinking about those grandkids, if they're inclined to put money away for education, one of the most popular opportunities are 529 plans. So they can not donate, but they can contribute to a 529 plan. Is that a tax deduction on the federal return? No, it could be a tax deduction on the state return, but here's the nice thing. It's moving money out of their estate and allowing that to grow tax-free for their grandchildren. Because these folks aren't working. So they can't contribute new dollars into a traditional IRA or a Roth IRA, but they can certainly contribute to a 529 plan or do Roth conversion. So there are definitely things someone like this can do. And one of the things that as tax professionals like to help them do is fill up their marginal tax bucket. So John, what that means is, let's assume, I'm a big proponent that marginal tax rates lie to us, right?
Or tax brackets lie.
Lie to us. I'm sorry, marginal tax rates are the truth. But let's assume someone's in a 20% marginal tax rate between federal and state. And we look at it and we say, you could have earned another $50,000 and only paid 20%. And they say, well, I'm not working. That's where we say, well, okay, let's accelerate income. Maybe we take 50 grand out of the retirement account, or we do that Roth conversion for 50 and say, look, lock in the tax now. You're going to pay a 20% tax because we know down the road they're going to have these required minimum distributions. And we know we're not going to live in this 20% world ever again. So similar to, sometimes you can buy tickets to a concert in advance for a small discount and lock yourself into that good seat and not have to hit the secondary market.
I always think of it too when you talk about, your role or those that are also like tax planners, right? It's almost similar like an interior designer, right? Like they're coming into something, you stepping into somebody's tax situation. You're not in theirs specific every day, but you know how things are in the future. Like say a designer came into a house and they said, you know what, it's really great that you want to do this and you want to do this. Here's some ideas. Here's why. Oh, are you going to have a family? You want to start a family? Yes. Well, I don't recommend doing this now because if you do this now, it's going to impact you when you have a toddler running around. So little things like that, where you're very similar to that. I think like if you're in it all day long, you get the blinders on, right? Or things kind of fall by. But when you come in, you see all this stuff and you're seeing it and you see how it is now versus what actions need to get taken. So it's optimized in 3, 5, 10 years, right?
Absolutely. Yeah. And one of the things, the other consideration for Mr. and Mrs. Pickleball is drawing Social Security since they're in their late 60s. Do we wait it out and go full Social Security? Do you draw it earlier? One in the hand's better than two in the bush. We typically look at, a break-even point somewhere in their mid 80s, right? And so, gosh, there's just a lot to consider. Does one of the spouses have more in a retirement account than the other? So these are the things we have to think about. And what we find is, especially for these pre-Social Security drawing retirees, like these pickleball folks, there's a lot more coordination between their estate planner, their financial planner, and their tax planner. Now, there's just a lot more. And that coordination should be occurring earlier, but that's, those are some of the things. So if you're in this situation, you might have a parent that's in this situation. John, we have parents that are a little older than this, but they were in this situation 10 years ago. They did a good job planning. You might be in this situation. Heck, you might even have a grandparent in this situation and you're just getting ahead of the game. So congratulations on that. Have them listen to this and think about, are they in the exact situation as the case study from this beautiful book? No. But what are the thoughts? What are we thinking about? How do we plan for retirement distributions in a tax efficient manner? How do we make sure we maximize their Social Security benefit? And how do we prevent hidden taxes like Medicare surtax or higher taxes on our Social Security? And those are the things that we have to think about when we're planning for these type of people. And John, as you know, with the One Big Beautiful Bill Act, we now have we have a new senior deduction for anyone 65 or older, right? But that phases out. So for these folks, that could be significant. We want to take advantage of that deduction. And it's $6,000 per person. That's $12,000 deduction. So but that's based on their adjusted gross income. So there's just so many things that play a role. And so the point is, as we wrap up, no matter what, if you're in your 60s playing pickleball every day, tax planning could still be for you.
You got it. And it's a great pivot point as we really get into the other episodes we have coming up. We have some of them that I'm not going to give anybody a hint, but it's been on the roster for a while. We have a great guest joining us on that one, but Chris, really, I will end with this part. Besides telling people go to that defeatingtaxes.com is kind of your central point. We'll send you anywhere that you're looking for more information. But it really is where everybody's tax situation is very different. Even if it's one little thing, it is very different. However, the best mindset is the same, right? And that mindset is really just wrapped around and encompasses the whole idea of planning for it, and that it's not just a once a year activity and you're done with it. It's ever growing, ever evolving. So everybody think about that when you go to sleep tonight and lay your head on your pillow. We want you thinking about taxes because it's not too early and it's not too late. So remember that and check out that defeatingtaxes.com. We will see everybody back here again next week on the Teaching Tax Flow podcast. Have a great week, everybody.
The information in this podcast is educational and general in nature. It reflects the opinions of Teaching Tax Flow and does not take into consideration the viewer's personal circumstances. It is not intended to be a substitute for individualized financial, legal, or tax advice. Consult the appropriate qualified professional prior to making any decisions. Securities are offered and supervised through Cabin Securities Inc. member, FINRA, SIPC. Investment advisory services are offered and supervised through Cabin Advisors LLC, an SEC registered investment advisor. Chris Picciurro is a registered representative of Cabin Securities and an investment advisor representative with Cabin Advisors LLC. Teaching Tax Flow is an independent entity and is not affiliated with Cabin Securities or Cabin Advisors.